Muskan, thank you so much for joining us here at SuperInvestor in Amsterdam.
Thank you, it's delightful. It's been a real change to Paris, and I'm really happy to be here. I think the organizers have done a phenomenal job.
Fantastic. Now, always busy, lots of discussion going on, particularly about this overheated market we're living in at the moment. What are the best strategies for people here, and coping strategies, if you like, at the moment?
Now, I've been doing what I've been doing for well over 30 years, and every year I hear this word overheated. I don't believe it whatsoever. When you look at exposures in the asset class, whether you look at the new investors, they're at 1% of total assets, if at all, 2% of total assets, and where the capital within the industry is quite structured and institutional now. And in an earlier session this morning, I think it's 4 trillion of AUM around the globe. That doesn't necessarily reflect at all or make any dent in the economics or the economic environments in which we're moving forward in. So it's not an overheated market. And what we do have is we have very skilled and very good groups that are working within it. So,
is that what history's told us before, though, when there's been this much dry powder around? Because there has been, sort of recent crises, haven't there?
I don't think there's that much dry powder around, because at the end of the day, the industry is filled with very talented people. They're adaptable, and as long as they stay crunchy and have a desire to be able to continue performing. I think what is happening is that there is a balance that's changing with the large investors being able to do the deals themselves because they want to push their programs more forward. And if you think about it, through the funds, where you claim to have an overheated environment, access is actually getting more and more difficult if you are a substantial pool of asset. And the assets and the assets available to the industry are just going to grow. I mean, I can name a number of countries in Asia where their pool of pension plans will be 5 times, and in one case in China 10 times in the next 5 years than what they are today. And they're at 1-2% in alternatives. And they should be around 10% in alternatives to run the program properly within their portfolios, right? So there's going to be a lot of change. And when you come to a fund, the funds are all capped. The funds all have existing investors. So access does become an issue. And the other thing you got to remember, outside the United States and outside of Europe, the only other country that has $5 billion funds, or even $3.5 billion and above, is China. Everybody else is a couple of billion below. There might be an odd exception here or there, but the absorption capability and the dynamic is quite extreme.
What do you think are the best strategies in Asia, China? You mentioned it there. It's an area that people have been a little bit shy of, a bit wary of, they're not sure what's going to happen in that part of the world. What would you say about that?
How can you say they're shy? Because you got to remember, you just have to look at portfolio construction. After the financial crisis, the average investor is targeting a 2x net return. And that return, they need to have diversified geographically, because they used to have too much exposure, more in the United States, more in Europe, depending which side the investor came from, and very little outside. I don't call them emerging markets anymore, because as of 2012, the non-OECD countries dominate global GDP. I call them new markets. It's a time of settling, and it's a time of change, and a time of moving forward. So within these new markets, when you look at them, you can see a very large ability of change that takes place. And if anything, within the investor portfolio, they are at 0 to 3% non-US, non-Europe. That will go to 1/3 of the portfolio. And so the transition will be quite important. The one country that can absorb that type of capital, and that as it moves forward, as it starts doing more control, as they've just had the first full cycle from a venture into a buyout in China in terms of one of the large companies that went through the cycle. China is the one that can absorb this. And behind China comes India. And, so over the next 10 years, these conferences and the topography and the audience in the conference and also the panelists will be changing. But within those, it's always the same. Because what you're looking at within private equity, there are certain types of companies that are more conducive to multiple ownerships.
And you think that this industry is truly embracing that change and evolving, as it should?
Absolutely, absolutely. But going back to your sectors, like for example the consumer sector, where in Asia there's a very high component to it. If you look at venture capital, which originated in the United States in the 70s, venture capital in the United States is predominantly IT oriented, and then there's healthcare. Whilst if you go to venture capital in Asia, it's predominantly in China, it's consumer and then IT, right? So it's a very different dynamic. And the one thing you got to remember as these new markets come, they don't go step at 1, 2, 3, 4, 5. They go step 1 to step 5. And so, if you look at the mobile phone technology, they didn't go through landlines and then figure out how to send SMSs. They've gone straight into app users, and they're more advanced than we are in terms of their applications, right? So that type of dynamic will work really quite well. And so the private equity community, you've got large organizations that need to decide how global they want to be. You've got more localized organization that, depending on the nature of their portfolios, whether they need to have offices in Asia and offices in the United States, which I'm meeting a lot of mid-market groups, funds that are €1 billion in size, right, even less sometimes, will have these structures now. But that's contingent on the types of companies that they invest in, right?
Are they investing in that? Because it is a relationship business, it's truly sort of spreading out geographically and looking at those regional offices. Do you feel that is really progressing?
Well, it's all about globalization and being able to kind of move the companies around, right? Because when you're looking to develop a platform or a portfolio company, some of the best acquisitions you can make could be in the United States, and then moving the headquarters from Europe to Asia might then be able to put you in a much stronger position. So there has to be this lateral type thinking. But the one thing about the private equity community, which is different in US and Europe, first of all in the United States they're very sector specific. In Europe that hasn't come yet, they're still regionalized. Then within that concept, you then have to decide what you can do with a company. And you don't need to take the company to its end marker. You can take the company to a certain level, and then someone else will take it the next level, right? But within the new markets, a dynamic which is quite interesting is the question whether a 5-year, 10-year structure, which is the common in the US and in Europe, is the right model for it. Because often sourcing, which is more an issue of the overheating that you mentioned, its ability to create deals. In those markets, there isn't a secondary capability, i.e. selling one company to another general partner, who then sends it to another general partner. And so you don't have that. It's not that common. And some of the companies that they create and invest in are exceptional long-term companies. And so I'm arguing to the investor community and to the general partner community that if you've got jewels or exceptional companies, let's try to figure out how to keep these for a much longer period. Then have to, like, the next time you come fundraising, sell your jewels.
So long-termism.
Well, think about it. You're selling your best companies because you're coming fundraising every 3 to 5 years. You're keeping the companies that are underperforming because they need a bit more work, and that's fine because you're capable to sort them out, right? But by default, that will affect the performance, right? Yeah. As opposed to being able to kind of hold things much longer and really drive that performance, right? So we have to kind of rethink this, right? So on one side is that dynamic, and on the other side was the dynamic I mentioned before, where you have a substantial amount of capital that wants to be deployed in private equity, and it can't work in through funds. The funds can't absorb them. The re-up rates are healthy, access is difficult, so the best way to deploy the capital, if I have $1 billion I want to deploy with you, your fund will only take $350 of my money, I'm just going to go do the deals myself. Yeah. And then you can join me. Yeah, right?
So there's different, they're using different models as well.
It's changing very much right now. It's all going to be, in the next 2-3 years, it's going to be very interesting.
Interesting times ahead. Thank you so much for sharing your insights, Moose.
Well, thank you.
Nice to see you.
Great pleasure. Thanks.